All right, y'all. Well, we got a slew of economic news this morning. It's why we're doing this call on Friday today rather than yesterday. Let's dive right into the numbers, y'all. We got news that should have moved the bond market strongly. It should have pushed interest rates significantly lower. It did not, and we're going to get into the reasons why. But first, let's look at the numbers according to Mortgage News Daily. Not a happy report today, y'all, if you're looking for lower interest rates. Today, the national average for a 30-year fixed-rate conforming loan, again, according to Mortgage News Daily, is 6.41%. Y'all, you have to go back to September 4th of 2025, a little over 7 months ago, to find rates as high as they are today. So not great news going into the spring buying season. 1 week ago, y'all, we were at 6.14. We were at 6.04 30 days ago. That's a big move, y'all. When we move over a third of a point, inside of a 2 or 3 week period, that's a big deal. Let's talk about what should have pushed interest rates lower. We got gross domestic product. This is the second read on the Q4 GDP, y'all. It was revised downward to 0.7% growth. Market was expecting twice that on this revised report. So big miss to the downside on the growth of the economy at large. Personal consumption expenditures, the Fed's favorite read on inflation, y'all, came in at 2.8% on the headline number. 2.9% was expected. So we got a better than expected read on the personal consumption expenditures, the rate of inflation. Lastly, we got durable goods came in dead flat, y'all. That was expected to be up 1.2%. So that's a very significant decrease in the amount of durable goods that were measured in the last month. All of these things, y'all, in and of themselves would have probably rallied the bond market and given us higher prices in bonds and lower yields in rate. We didn't see that because the price of oil is trumping all of it, y'all. Let's look at oil. 30 days ago, a barrel of oil was $60. Today, a barrel of oil is $95. That is a 55% increase in the cost of oil, y'all. 30 days ago, a gallon of gas was $2.94 a gallon, national average. Today, it's $3.63 a gallon. That's a 23% increase in the cost of gasoline, y'all, with probably significantly more to go when you look at the supply of oil and the increase in the price of oil. We are definitely selling off some existing reserves in order to keep gas prices up roughly half what the cost of oil is up. Those will start to pair up, y'all, so we're going to probably see significant increases in gasoline going forward until we get the price of oil down. That is what is rallying or concerning the bond market, y'all. Anytime that you have something as core as energy, the cost of oil, going up so dramatically, you have to expect that future reads on inflation are going to start incorporating those higher prices, and that's going to put the Fed in a position to find it very difficult to be more accommodative with regard to rates. So we are seeing that, y'all. The Fed futures are down significantly for cuts at either of the next 3 meetings, about half what they were even last week, or certainly before the war started in Iran. So here's the bottom line, y'all. When we have all of these reports showing significant economic slowdown, we got a weak employment report the week prior, or 2 weeks prior. When you put all of those things together, it really suggests that interest rates should be significantly lower than they are now, if not for the cost of oil. So here's the multi-trillion-dollar question, y'all. Is the U.S. military capable of keeping open a 2-mile swath into the Persian Gulf? Because if the answer to that's yes, then these increases are short-lived, and we're going to see a quick return to proper supply. If the answer to that's no, then we're going to be in for a long ride. I happen to be of the belief that we are more than capable of keeping open a 2-mile stretch into the Persian Gulf. So I'm absolutely bullish on the notion that we're going to see lower energy prices soon, y'all. In any event, that's my take. That's what's moving the markets. That's what's pushing interest rates higher. Hopefully it's short-lived. I believe it likely will be. Don't know what short is defined as, though, y'all. It's going to be a little bit rocky while we get back to normalcy. So anyway, continued prayers for our troops, continued prayers for the success of this mission, continued prayers for our country during this time of war. Stay blessed, stay safe. More to follow next week. A lot to talk about on these weekly videos, y'all. Stay blessed. We'll talk to you soon.